You've heard the expression, there's an easy way and there's a hard way. Well, when it comes to equity plan accounting, that expression is a little different. There's a hard way, and then there's an even harder way. In this video, I'm going to cover 3 things that make equity plan accounting even harder, starting with retirement provisions. Let's face it, everything about paying out equity awards to retirees is complicated. It's complicated from an administration standpoint. The tax treatment is crazy complicated, and it's complicated from an accounting standpoint. Automatic payouts to retirees can reduce the service periods of awards, sometimes in ways that your finance team might not be prepared for. And if you make discretionary payouts to retirees, well, those payout decisions could be treated as modifications of the equity awards. We'll talk about modifications in a minute. Another area where equity plan accounting can get very complicated very fast is when you have grant date misalignments. So when your grant date for accounting purposes is different than the grant date for tax or contractual purposes. There are a couple situations where this can occur. One is when grants are issued contingent on some sort of subsequent approval. For example, if you grant equity awards, but the awards are contingent on shareholders approving an allocation of shares to your equity plan. In that case, the grant date for accounting purposes will be delayed. Another situation where this can happen is if the material terms of the award aren't communicated to the award recipients within a relatively short period of time after grant. In some cases, those material terms aren't even defined until sometime after grant. For example, with performance awards, sometimes the targets aren't set until after grant, sometimes a year or more after grant. All of that is going to delay the grant date for accounting purposes. And that is going to make the accounting treatment complicated, particularly when you're comparing it to your tax and administration of the equity programs. There are some other grant date misalignments that can also complicate things. For example, if your vesting commencement date is different than the grant date, maybe vesting commences on the employee's hire date or on a date after grant, that's going to affect the service period of the award, again, sometimes in ways that your finance team might not be prepared for. And sometimes the grant date and the service inception date can be different, and that will also impact the service period for the award. My third area where equity plan accounting gets mad complicated is award modifications. If you are making changes to the terms of your awards, that oftentimes will impact the accounting treatment. Oftentimes you'll have to revalue the award. Sometimes some of the expense before the modification is reversed. Sometimes it isn't. Sometimes there's incremental cost or additional costs that the company needs to recognize. Sometimes the service period will change. This all gets very complicated very fast. Some of the types of modifications that can impact the accounting treatment are changes to the vesting conditions of the awards, extension of the post-termination exercise period, and of course, repricing of stock options. But those aren't the only changes. Really, any change that impacts vesting, that impacts the award's fair value, or that impacts the equity or liability treatment of the award. For example, paying out awards that were supposed to be settled in stock, paying them out in cash would change them from equity to liability treatment. All of these changes are considered modifications, and they have to be accounted for. The accounting treatment can get pretty complicated. There's obviously a lot more to know about these 3 events that I just went through. And the webinar, 10 Things That Complicate Financial Reporting for Equity Awards, covers them all in more detail with examples illustrating how the accounting treatment works for these situations. Plus, the webinar covers 7 more ways that equity plan accounting can be complicated. You are for sure going to want to give it a listen. We'll include a link in the show notes. I hope you enjoyed my video today. If you did, hey, why not share it on LinkedIn? Maybe some of your colleagues are worried about how their equity plan accounting might be complicated as well. And those shares really help us out. Win-win. Thanks for watching.